Okay. All right. So we're recording this. I'm starting the webinar too. Okay. Okay. Look at us. We're rolling. Um,
All
okay,
right.
guys. As you file in, so to speak. I don't know if anybody was really filing in, but I'm here with Andy, and we were just talking before. We were just talking before you got on that I've decided that I'm going to do some. I'm going to go through some slides and kind of teach you some of the things that, and you can see this covered strangle SMCI, a 4-day trade. I'll kind of give you an update on that, but I'll show you the covered strangle. I'll also show you the covered straddle, which is really cool. Just kind of my way of teaching it, and then hopefully that'll help when he's got his slides, he's got his approach. He even has his accent that I don't have. So it's a different guy altogether. So let's just, you know what, man, let's see if we can make some hay here while the sun shines. And I know a lot of you guys and ladies are here from Stock Market Mentor because I just thought, you know what, let's everybody try to get let's just try to get familiar with options. One thing that I would request, and I see some of you already, use your emojis. Let us know. It really does help. And I'm not looking for a pat on the back. I can do that myself. But it's really helpful to know if we're talking about something and you're saying, like, this is really valuable. Okay, give me a thumbs up. Give me a whatever. Just don't give me a turd or a thumbs down or whatever. But just let us know that it's working. And because that's what helps. Like if I see a bunch of stuff, I'll go like, okay, well, let me see if I can do more of that. All right. So anyway, so here's the thing. I mentioned this, but I think I was just talking to OMMers. I really can't remember, and I apologize for that. I got a lot of stuff going on these days, some of it good. Um, so I was looking at SMCI here, and I was looking for a candidate to do simple option premium selling, and that's what Andy's going to talk about. And I saw this, I saw it was down so much, and went, okay, I'm going to make this my BITCH. I'm gonna trade this stock because it. And somebody in the trading room had mentioned this. They go like SMCI. I thought Dan would never look at that kind of thing, and I wouldn't. But I'm doing a different strategy now and I'm trying to show it. So, sure, let's look at it. So the idea was the stock had fell and I saw it the next day. It kind of cut this level here. This is when I drew my box. Yeah, on the 23rd, which is this day. So on the second day, this was what I was looking at. And the idea was this. I want to kind of bracket it with options. So I'll show you this. Yeah, this is what it looked like. Do you guys remember this? Anybody? Because I showed you guys this, but I don't think it ever hurts to repeat. Okay, so good. All right, second time. Let's do it better. So you buy 1,000 shares at 21, so that's $21,000. Now that gives you the right to sell, and the shares are at 21. So you sell a $20 put and you get 55 cents for that. So what this $20 put means is that if the stock falls below 20 bucks, you have to buy it at 20 bucks. You say the stock is put to you or the put is assigned. It's a contract that you have where you go, I'll buy the stock for 20 bucks. That's your contract. That's your obligation. If the stock stays above 20 bucks, you don't have to buy it because you'd love to buy it at 20 if it's 21. So you're taking 55 cents in for this, which means that if the stock does fall below 20 and you have to buy it, your actual cost basis on that is $19.45 because you bought the stock at 20 bucks. Now, then you've also got the shares at $20 too. So you've got more stock, but it's a lower cost basis. And then you sell the calls at 30 cents. So you're getting a lot of bang for your buck here. You're getting 85 cents on a $21 stock. And in fact, and I'm gonna do the calcs here. Okay. So that's a 4%, a 4% return just on this. And it doesn't seem like much, 55 cents, 30 cents. Yeah, it's a $21 stock. What do you want? $8? So you do this 1,000 times and you got $850. That's 850 in your account, in your pocket. And that happened last Friday. And so this is just kind of how this works, right? And so if the stock's called away at 23 bucks, I make $2,000 because I bought it at 21. And then I also get to keep the 850. I get to keep the $20 puts because those expire worthless. I get to keep the $23 calls, the 30 cents, because I'm having the stock called away from me. So this whole thing, 850 bucks, I get to keep. And that gives me a total of $2,850 in profit. So that's 13.6% in a week. Okay. I made that trade. Hopefully some of you guys did too. And so the deal on this though is you've got a maximum risk. And so let's say the stock falls down below 20. Now you're in for $40,000. By the way, if you only do 100, then you're in for $4,000. I just use $1,000 because that's kind of the audience that I'm speaking to here. So your total cost is this, which means your max loss is if the stock goes to zero. And by the way, that's why they call it a cash secured put. You have to have this kind of money in your account or you cannot sell these puts. So maximum risk, if the stock goes belly up and everything goes to zero, you have to have $40,150 in your account. Okay, so then your break even is here, $20.08. And remember, you bought this stock at $21 initially. So I think this is like a pretty good deal. Your profit above 23, that's the max profit. You want it to stay in between 20 and 23. And then let's see if it did. Yeah, I knew there were more. Yeah. So this is where the stock closed, and it closed at 21. Um, yeah, it closed at 21.97. And we wanted it to stay below 23, which it did. And we wanted it to stay above 20, which it did. So we got to do this all again. I don't think I put this out, although I might have. But the point is, you just say, okay, thank you. I've got that money in my pocket. Thanks a lot. And then you just do it again and you do it again. And so this is really, really easy stuff here. There's a lot of numbers here. I mean, a lot of moving parts here, so to speak. But if you really break this down and if you just do a few of these, you will find that that it's really not that hard because where you start is a covered call. You buy the stock at $21, you sell the 23 call. And then just wait and see what happens. It has to be a stock that you want to own. I kind of made the exception with SMCI because I'm familiar with that pattern. So no, I don't want to own SMCI, but I want to trade that pattern. I've seen it more times than I can think of. And it always does exactly what it's doing now. And it's going to continue to do that for at least another week or so, probably just kind of drifting sideways. So, but typically you want to be able to buy. You want to buy the stock. So you do it and then you sell a call. and you're capping your upside, no question about it. You don't buy it on a stock that's going to the moon. You don't do that. You do this on sideways stocks that kind of like what's happening now, which is one of the reasons why I wanted to teach this this type of session is people get bored. Like I can see it. I can see, I mean, there's always, 5, 8, 10, 12 people posting in the trading room every day because that's what you do. But I can always tell when the market's really crappy because the number of posts goes down. Cancellations go up. I've seen this for 15 years that I've had Stock Market Mentor. And I think part of the reason is because everybody's stock's going sideways and nothing's happening. So why do I care? So learning how to trade credit spreads like this gives you, not only does it give you something to do, but it makes you money. You just have to understand it. And these are really, really simple strategies. Buy the stock, sell the call, forget it. Once you got that figured out, maybe it'll take one trade, maybe it'll take 100, maybe you'll never get it totally figured out. Once you got that figured out, then I'll say, okay, let's sell a put in that trade as well. Now you're doing a covered strangle. You're strangling the stock. The other way to do it is to do what's called a covered straddle, where let's say the stock is at not 23.25, but let's say it closed at 23 bucks. So you sell a $23 call and a $23 put. They're right at the money. You're guaranteed that something's going to happen to your account. If it closes at $22.98, you're going to buy more stock. If it runs up above $23, you're going to get all the stock called away from you, but you're going to get a really, really nice return on that trade. And it should definitely be above 5%. It'll be 5 or 6% or sometimes even more for just buying the stock and selling a call and a put at the same strike. This stuff's super, super easy to do. Does this work for you guys? Are you getting what we're doing here? And this is just my cycle, where let's say you start with selling a put. You sell a cash secured put. Okay, well, the stock falls down below the put and you get it assigned. So now you own the stock. Okay, yay, I own the stock. You should never be, oh crap, I own the stock. You should be happy to own the stock. Now I own the stock, I'm going to sell a call. Bam, I get paid again, just like I did here with the puts. Okay, so you got a call short and then the stock gets called away from you. So now you're back to cash. What do? You do it again. Oh, the shares are not called away from you and your call's expired. Fine, do that again. Like, guys, that's the way I teach this strategy. So Andy, do you want me to give over? I think you should be able to
Yeah,
get on and share your screen. I got to get off of mine.
sure. Okay, all right. So let me see. Share my screen here.
And I'll tell you when it's on. Glad you guys are all
Okay,
here. Glad you guys are all here.
all right.
Got
Can
it.
everybody see me? Okay,
You're in.
okay, all right.
Yeah. Take your I think everybody need to take your image off the screen. Just put it on another monitor.
Oh, is it me or is it?
No, if you could, right, guys? Yeah, just
Mm,
move your the little box with your beautiful image on it. Because
Oh,
it's
oh,
on
you
your
mean
main
my screen?
screen.
Got
Yeah,
you,
yeah,
got you.
yeah.
Okay,
It's on
yeah.
the
So
screen
okay.
that you're sharing. So just kind of
Um,
take that
Let me
off.
see. Let me see. Sorry about that. This is the first time I
It
do this
happens. Yeah,
layout
no,
thing.
it's a
How
common.
about this?
Um, yeah, well, I think
Does it work?
X out of that if you can. Yeah, now I see the screen. Yeah, is that
Okay,
better, guys?
cool.
Okay. Okay.
All right.
Ken, glad you're here. Thanks for offering the options training session. Yeah, I want to, by the way, just real quick, we are going to make some changes. And I know some of the old farts in the forum, they've been there forever. And I love our old farts. I've been with you guys forever, too. We're all in the same boat. But I'm trying to introduce options to you
Mhm.
because we want to be combining. We want to be combining the two. It's just a better way to go. So I think that the only way I'm going to be successful at that is if you're successful. And the only reason you're going to be successful is if you understand this stuff. So that's what I'm doing here, and that's what Andy's doing here. And Sam, he's doing that too. He's just off for a few weeks because of tax season and stuff. So anyway, I'm happy that you guys are here. That's why I made it for everybody. Okay, go Andy, do your thing.
All right. All right. So the first thing I just want to follow up with, you talk about the blue collar option, right? Actually, the only one that has been working for me this past couple of weeks is the same similar trade. It's on Pfizer, okay? And I've been trading. I'm selling put, getting stock assignment, and then selling calls against it, and all this stuff. And I mean, in terms of percentage, it is lower because of the stock, right? Because you have the stock price there, the stock cost there. But in terms of dollars, if you look at this for a couple of weeks, I got $5 out of it. If you look at all the closer trade, the other trade, I have a Coinbase trade, $3. I have better trade that's Costco, 14, $13. So the I would call the blue collar trade is actually working really well, right? When you find this, okay? This is something that I plan to talk next time. So maybe next week I can go
Yeah.
over that next time, okay? So just so that I want everybody to know this strategy works, and it has been one of the strategy that you can see from the OMM website. Okay.
Hey Andy,
Hmm.
Um, so I don't mean to interrupt your flow here,
Sure.
but I
Hmm.
just saw a text from Ken, and he
Yeah.
said it's the first time I'm seeing Andy. Can he offer a brief background since we're
I see.
likely to see more of him in the future? So, um,
Sure.
tell people who you are, buddy.
Okay. I have this slide here just in case somebody asks. Okay. I am the handle called Right Path. I have been a member since, gosh, 2011, 15 years, right?
Mm-hmm.
Long time. I think I joined at the beginning of, when you start having the transition from the newsletter to, like service with the
Yeah.
website and all this stuff. And I am obviously in the OMM beta and then also in the CMM also. My day job is an engineer, is a engineering manager. So think about I'm the math guy. I like dig into stuff. So when you look at my stuff, I talk about number a lot, okay? Because I like to dive into the number. I want to understand what the number means, right? And on the other hand, for my management job, I need to handle risk. So that is one thing that is, I think everybody need to know. If you do option, you need to think about risk first. Okay, you handle the risk and the profit will come. And that actually is something that I deal with every day. I need to deal with the risk, make sure that we can move forward in projects and things like that. So in my lots of trading, I'm looking for consistency, something repeatable, something that I can manage the risk. So this is a quick introduction for myself. Okay.
Okay. That works. That works.
Okay.
Thank you, sir. So basically, everybody, Andy's real smart. Okay. That's all. He's really, really smart.
I just like numbers. So let's take a look. Okay. So today I want to talk to you about the spread. One of the thought is that I'm debating whether to go with the blue collar option style, the Pfizer trade that I show you guys. But I thought in this environment has been really hard. One day somebody say something and then the market go one way. Next morning it go the other way, right? So I want to show you guys a lot of the trade that I did recently, at least, is using spread, okay, vertical spread. It is a risk limited trade. Now I say risk limited. It's not because that it is, somewhat, I should say it is limited, but it's not. it's not something that you can avoid. Okay, so you are doing a trade that you limit the risk, you understand the risk, you know the risk upfront, but it's not eliminating all the risk. Okay, so I want to make sure everybody understand that. So we still need to deal with risk. You have a better understanding of the risk instead. Okay. So a quick intro, I want to map also all this stuff back to our website. So if you join OMM, if you go look at it, it will all make sense. Okay. So when you look at a trade, look at a note there, why do they have this trade here? It will all make sense for you. Okay. So the first thing, okay, what is the trade? How do we set them up? Okay. Now, I want to ask you guys a question, honest to yourself. Okay. If you look at your account, trading account today, which which pattern do you see your account balance looks like? Okay. I know there will be people that going up and down. There are also someone that is, in stair step, you're making progress, and maybe even linear if you are doing good. Okay. And I just did mine. I go look at mine. This is what it looks like up to the first quarter of 2026. So I think the process work. If you deal with the risk, okay, the process should take you out when it is a difficult time. And the process is going to let you in and you find more trades so that it will help you to grow your account. So you can see this probably is a time that there's an easier environment. If you go look at SPY or something, that is the part that we have like ramp up of the whole market. So this process should take advantage of that and let you in more of the trade. When it is now is flipping up and down, the process is going to take you off the trade. Okay, so you need to have your process that can work with the market, right? And so my process is this one page. Now I know the number doesn't make sense now. I will make sure that you understand every single things here. My process to do vertical spread based on what I call support and resistance, and it looks like a channel. And I'm doing all the trade within when the price is within it. Okay, and there are a couple things that I highlight. It is vertical spread. I have some volatility IV that I'm going to talk about. I'm going to talk about delta in very simplistic term, and then I'm going to have the DTE, how long this option is going to last, and then how do I define the spread and the exit. Okay, don't worry about the number now. You will understand 100% in the few slide. Okay, so first thing, when you go to the website, there are the note. Okay, so if I go to, let me switch to the website. So you can go to the website, you see a tray here, there's an icon I here that bring up the note. And in the note, there is the actual tray. There are sometimes a multiple of them because there are multiple conditions there. We'll talk about that. And for example, some of the trade that I have in watch, for example, here, and then this will have the note saying that what are the trades there, and I also have the week that it is targeted for. Okay, so last week, actually this week is week 13. Next week will be week 14. And I even give you the chart that when I'm looking at the specific ticker, this is a condition I was looking at. It was almost bouncing from, for example, in this case, bouncing from 200 days. So I probably have a bullish trade if it is bouncing, something like that. Okay, so that is the notes that is in the OMM website there. Now, after you know the website, have the note, have the trade, so what are the trade? How do I actually understand it? Okay, so the trading process is this. First, this is my part of the work. Okay, I work in the background. I'm looking at a lot of symbols and companies and stuff like that. And you can see, I give you a favor of what I'm looking at. I have this channel that I'm talking about. I'm looking for a specific stock pattern, right? I only trade the pattern that actually meet my criteria. I don't go trade some random stock. So if you remember, Dan will go through a lot of trades, lots of chart, and they'll say, nope, 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 nope. Yes, this is the one I want to look at. So I have a list like this also. So I will go through a lot of chart, and when they fit that pattern, I see it go inside the channel. That is when I want to apply this process there. So the first part is I'm doing some research looking for a specific pattern, and I only work with that pattern with that specific strategy. That is vertical spread. Okay. Now, once I have that, And the next one, I'm going to have some chart that do deeper analysis. I need to know the support and potential resistance. So in this case here, this is Pfizer trade that I had before. Oh, I probably jumped ahead. So this is Pfizer trade here. Okay, you can see a support here and then a resistance up there. So this point, if it stop bouncing, that is when I want to do a trade, a directional trade in this case. I am expecting it go up, right? And then additional one, for example, this AMD, also in the same boat, if you will. Okay, also at the bottom of it, I'm expecting the higher chance, if you will, going up to the top of the channel there. Now, in the chart there, if you click on the chart, you will see two things, okay? One is this cone here, okay? This is basically projecting all the probability. That is one standard deviation. Don't worry about the math there. It's just giving you sort of like a crystal ball for today. It only valid for today, right now you're looking at, okay? So this is telling you where the price can go. Now, if the price, usually in this case, yeah, I'm looking at this price as at the bottom, and when it projected, it should not go to the top too fast, if you will, right? So give you some idea when my perspective is going to be right. Okay, so there's a good chance that it go up there. That is what the chart is saying with this chart here. And this particular um, indicator is available in all the tools. I have different tool here. All of them have some kind of projection like this. It is
Where do
called
you
the
get that,
price code.
Andy? Where
It
where do
is
you
the
get?
I am using, let me see, I am using the TOS. You can see the screen here, right? TOS
Uh-huh.
have this screen. And let me see, I think it's called the PEC, price something. I always
Okay.
forgot the name. It is probability of the expiring cone.
Okay. I got
I
it.
think all of them call something like this, okay? So you can consider this is a poor man version of the crystal ball, okay? Tell you a little bit what the market expectation based on all the option, okay? So that it gives you a projection where it is going, okay?
Hmm.
Now, it can be up and down, you don't know, but at least give you some directional kind of context. If you look at this one here, you can see going up is more likely than going down, right?
Hmm.
Okay,
Yeah.
so that helped me give the direction. Remember, I'm trading direction, so I need some kind of directional guess, right? Another thing I'm looking at is actually this is talking about detail. The detail is this cone here. You can actually formulate it. If you look at the option chain, this is all this number here. Okay, plus or minus 43, no, plus or minus 8, plus or minus 11, 13, 16. It just chart of this number onto this area here. Okay, so it tell you where it can be going. Okay, and then the other thing I look at, for example, in this case here, the support in this trade here, I think I have Coinbase. Okay, I'm going to look at different time frame. Okay, I had a trade that when it is hitting this channel here, everybody got scared, and then I said, wait a minute, let me take a look at the weekly chart. Well, it's bounced before, so I can put a directional trade here. So I published a directional trade, and then I traded this upside channel there between the channel. Okay, and then the next thing, once I have the directional preferences. I'm going to, oops, sorry. Where was it? Did I click on the button? Yeah. When I have the directional preference, I need to have a plan. What exactly the trade I want? Okay. And sometimes I will have both sides because there may be right at the 50-day moving average. I can be going up, it can be going down. If it break down from the 50-day moving average, it go down, right? If it break out of the 50-day moving average, maybe go up. So I may have two sides of the trade simultaneously. Depends on what the condition is, then I will trade that. Now, get back to that numbers I'm telling you, okay? So number one, I have the volatility here. I plotted this data chart. You can get this as IVR or IVP, which is implied volatility percentile. I think all the charts should have something like this. When you plotted this, you get a historic view of what the implied volatility has been. It is very simple. I look at it as buy low and sell high. I want to sell, right? I want to do a credit vertical spread. I always want to sell it when it is high. At least it's not low. Okay. So the first thing is I need to make sure it is not low. Okay. So that is one check. If it is low, then I say, this may not be a good time, right? Then the second number, I have the delta there. The delta is telling me that where I should pick the strike. Okay, so for example, in this case here, I'm looking at AMD. If you remember the chart there, it is right at the, I think it's right at the 50-day moving average. Let me go back and see. Let me make sure I have the chart here. AMD, okay, it right at the 200-day moving average. Okay, so for this one here, I said it can be usually 33 delta, okay? But if I have a support, which is the 200-day moving average, I can go a little bit more aggressive to 40, okay? So when you look at the chain, you can say, okay, I have two numbers here. I can do a 33, 32, or the 40, okay? So I'm going to look at, you should have the delta number here. You look at, you can see 39, 35, 31. So these are the strike that I should consider. Okay, this is how I would build that spread from. Okay, and I'm building this starting with the short side. I'm selling this and then I'm going to hedging the other side. So I should start there. Now, with that, how do I know how wide the spread is? Okay, so the question is, what is this number here? 1/3 of the spread. Okay, so I always want 1/3 of the spread. I'm going to show you the number. What does it mean? Okay, so if I'm doing a $5 spread, it will be $1.70 as 1/3. Okay, $1.67 to be exact. Okay, if it's $10 spread, it will be 334. If it's $20 spread, it will be 670. If it's $30 spread, if we can get that wide, it will be only $10. Now, why do I pick that number? When you look at the probability, this is a formula, okay? For example, if I'm doing a 32 delta, that means that I have 68%, 100 minus 32 is 68%, that I will get that premium that I sell it for. That is a 1/3 of the 10. Okay. So in this case, $33.50, I will get 68% of the chance to get it for a net profit. But I may have chances that I lose, right? So 68, if you 100 minus 68 is 32, which is a delta. Then in this case, I have a spread of $10. That means I have the risk of $6.60. It's 10 minus whatever premium you got. Actually, I have it wrong. So it should be actually 650. Okay. If you calculate it, you should have a positive number. Okay. This positive number is important. This is similar to, I think we talk about, you trade is like going to casino and then they have the probability. You want to be a house when you sell options. And what does it mean by a house, right? They have a probabilistic advantage over you. Okay, if you go to a casino, they have all this fancy food and restaurant and all the fancy decorations. It's because probabilistically they win. They always have a positive value. So if you play long enough, you are going to lose and the casino is going to win. So when I sell this, I want to know my net profits long term is positive here so that I know I have an advantage. If I don't have this advantage, let's say, for example, if the spread here only give me $3, and if you calculate, it will be if you have $3, this will become 7. Okay, if you calculate it, it will be a negative value. That means this trade, if I do it again and again, this type of trade, I'm going to lose money. Okay, so from these three number now, I know where to look for in terms of the strike. I know how wide it is, and I know what is the optimum spread that I want to get. I want to get something that is more than 1/3, a little bit more than 1/3, because that is usually what you see in my comment. I want more than 340, which is a little bit more than 1/3 of the premium. That is $10 spread between 210, 200. Okay. And then I will get to this positive overall net profit value. So once we have this, now I formulated this trade here. Now you can move it around and then we look at the premium and then you should get something that is net positive value. Once you have that, then what we have is like do it again and again. I can do many of this. For example, this Costco trade, I identify this bottom of the channel. I trade this all the way up to 200-day moving average, and then I'm done. Okay. And then you can see there are a whole bunch of trade that I am trading. And this is one of the profitable trade earlier in the January until I think February when this is the move. So both of them like 13 bucks, 14 bucks per contract basis. That is usually pretty good profit there. Now I have the trade noted in the system. Now when you look at it, you will find the trades that is in the watch section or in the open, all of them in the eye icon here as the note. When you see that, all you need to do is find the trigger. Now you know what option to trade. What are the short leg? What are the long leg? Now you need to set some kind of alert. So what I do is usually I do it before the open. Okay, so for example, this here I have the intraday chart here. So this is the black part is during the day. This is extended hour. So I will look for any highs and low. I actually list it out. Okay, so I will say that in the note here, I say when it is move above 50-day moving average at $215. Okay, so that here, this top part is the alert for 215. So when the market open, if it is above this, I'm going to execute this. Very simple. Okay. If it's below 200-day moving average, which is right here, okay, if it's below that, I'm going to execute the reverse of this. That is a bear call spread. The one that is above is a bull call spread, a bull put spread. Okay. So this is how the setup is. Once you get to this part, then that is a part that you will see the trade that is being executed, and later on we close them if it is profitable or hit their loss. I usually set something similar to Sam. If I lost more than 50%, I get out. Okay. Usually if it start feeling that is a problem, I also close it out. I also have a stop in terms of a stop on the price of the stock. So if the stock went to this price, I have alert. The alert come, I just sell them. Okay. So that is the whole process that I map to the OMM website, and you can see all the trade that I set up, I share with you, and then also how I enter and exit them. And I did a count on all the trades I did for the last 100. This is like year and a half. Okay, so you can see the betting average is about 70%. Then I borrowed this from the stock. I don't know if it is still valid for stock for option, but if I use the same calculation, I got the betting average of 70%. I do a lot of short, 78 trade of short versus 18 that is long. So you can see I'm selling for credit more than kind of like paying for the options, right? And then there's some statistic there, meaning that basically I'm doing okay. I mean, all the trade that for the year and a half, they have been profitable. So that is a quick way to get an introduction to the vertical spread. It is really short. Now, I didn't go into a lot of the details. Maybe in the future, there are opportunity. I can dive deep into each of them so that you know exactly why I make those decisions. But with this information here, you should be able to experiment and try out some of the trade there. Try a few, paper trade them, and see if it works for you. Questions? Let's see. I'm looking
Oh,
at
sorry,
the.
I was
Oh,
muted. So
no
sorry.
problem.
Yeah, go ahead, guys. Yeah, go ahead, Andy.
Okay. So I was trying to see if there's any question. I'm seeing that
Yeah.
offering interesting insight on how to pick the best spread. Can you present this in your own words so we can hear it again in different perspective?
Oh, yeah.
I
You're
think it's for
asking.
you.
Yeah, yeah. Can I present it again in my own words? On IBD
Yeah.
Live, Harold always picks a $5 spread, but that's not always the best choice from what I can see here. Um, okay. Yeah, I'll go ahead and let me take I'll go ahead and take the screen back here.
Mhm. I think there's also a question saying they don't understand net profit. The net profits basically is a long term. If you look at the probability, it's a approximation of what a long term profit and loss would be if you look at the probability there.
Okay. Yeah, here's the thing. Here's the thing, guys. Seriously, there's a reason why I call my strategy like blue collar options. Andy, and a lot of people really look at all the Greeks and the probabilities and the skews and all that kind of stuff. And I I don't. I mean, I've been doing it for so long that it's not like I don't have to, not at all, but I just kind of get a sense whether the volatility is there, whether the probabilities are there. But most of the time, I'm just looking at the chart. Can you guys see my my screen? Okay. Um, okay. Okay. Good. So what I do is I know, yeah, $5 spreads. The whole idea is this: you want to be getting a third. Ideally, you want to be getting a third of the spread. Take that in as premium, and that would be like on a $10 spread, $3.35 is really kind of what you're shooting for. And then
Mhm.
I'm looking for a delta, which is the delta is it's the equivalent of like the number of shares that the option controls. In other words, if the delta is 7 or 70, if that's it, I'll turn my camera on so you can see me. If the delta is 70, there. So if the delta is 70, that means that when the stock moves around, your option price moves like with the equivalent of like, let's say you own 70 shares. If the delta is 30, then the option moves with like you get 30 shares, that kind of thing. But it's also used as probability by traders. So if you've got a delta of 50, that means that there's a 50% chance that the stock's going to close in the money, meaning the option's going to be worth something, and also a 50% chance that it's not. You will always find that the 50 delta is at the money. If the stock's at $30, the $30 call and the $30 put, they're going to have a delta of 50. Could go either way. So what I like to do is I like to have a delta of 30 on call on things that I sell. Because if I have a delta of 30, that means 30% odds that the stock basically is where I don't want it to be. If I sell a $33 call and I own the stock at $30 and that call has a delta of 30, the idea is there's a 30% chance that that stock's going to get called away from me because the delta was 30. In this case, maybe I don't want that to happen. So I look at it and say, oh, well, there's a 70% chance, flip side of 30, there's a 70% chance that the stock's not going to get called away from me. Now, where this is really most important to me is when I'm selling puts. And like if I'm doing a bull put spread, like let's say the stock's at 100 and I want to sell a put on that, I might I'll look over and say, well, give me a 30 delta. Then wherever that strike is, okay, it's $100. The $80 put has a 30 delta. That's the put that I want to sell. And the reason is because I have a 70% chance of taking all the money. In other words, that option's going to expire worthless. Okay. But then I don't want to be selling a naked put. So then I'm going to buy a put underneath that. Typically, what I would look for is one with a delta of 20, maybe even a little bit less than that. But the idea is if I've got a delta of 30 that I'm short and a delta of 20 that I'm long, well, then the effective delta on my trade is 10. In other words, like the difference between the short delta and the long delta is 10. And what that means is the stock moves down and it's basically like I'm controlling 10 shares. It's just not that much. So I hope this makes sense to you guys. That's just kind of how I do it. And I prefer to trade with wider spreads and a lower probability of having that trade, having the stock go below the put price. I like to trade wider spreads because then I just collect more money and the percentages still work in my favor. Some people like it the exact opposite. They like the really narrow spreads, but that's kind of what works for me. Does that help you guys?
Let me add one more
Yeah, yeah, go
explanation
ahead. You
about
can take the screen
the
if you
spread.
want, Andy. Take the screen if you
All
want.
right. So I think David was asking, can we explain that equation how it works? So think about this, okay? If you were to do this over and over and over again, okay? So the goal is to sell something. We are selling the premium there. We're selling something and want it to expire worthless, right? And the delta is telling me the probability that is going to happen, right? So if I do a 30 delta, make it simple, 30 delta, that means that there are 70%, okay? 70% that this is going to happen, right? You just need 1 cent above, then you're done, right? So 70% of them. So let's say I do this trade 100 times. That means 70 times of them, I'm going to get that 1/3 of the premium. Let's just say 350, that example. I want it a little bit higher, right? So out of 100, I have 70 times because delta 30. I have 70 times that I will get that premium. But then there are the 30 times that is going to go against me out of this 100 times. So that equation is trying to look at this on a 100 trade basis. What is the net profit for that 100 trade would be if everything stayed the same? So this gives me an idea that over a long term, if I'm making money or not making money, one of the thought is that, or experience from that is, if I do it too close to it at the money, it's very higher, it's have higher risk. I am flipping a coin, 50-50, right? If it's too far away, the premium is so little, I just need to lose once, I'm losing all the money that I earned, right? So there must be somewhere in the middle where they are optimal. You have a better chance to be long-term profitable. That is what the probability equation of net profit trying to tell you. Would
Hmm.
that make a little bit more sense?
Makes sense to me.
Hmm.
Definitely makes sense to me.
Yep.
So, guys, let's see. Any other questions? Okay. Yeah, Vic, I assume you're okay with owning SMCI at its present price. Yeah, I am. Now, are you going to do the trade next week as the stock has had a really volatile history? You know what? Honestly, well, not that I'm going to be dishonest. I probably will do the trade, but the stock closed above my strike price, so I'm getting it taken away from me. And I won't have it in my account on Monday. So, and I've made really good money, kind of ATM machine kind of money on that thing. And so I'll probably look and just start the trade again. And maybe I'll just start with selling puts, or maybe I'll buy the stock and sell a put and a call. But probably just in this kind of weird market, I'll probably just sell some puts, weekly puts that expire on Friday. By the way, there it's kind of a popular theory that if you sell options before a weekend, like you sell them on Friday or you sell them on Thursday, you're kind of tricking the market because you get to take advantage of the Saturday and Sunday where things don't trade. So it's better to sell, all things considered, it's better to sell an option on Friday than it is to wait until the following Monday, just because you kind of get free days. Well, that's been proven not to be true. There've been, and I've done
Mhm.
research on this because I think it's a cool idea. But a lot of, I think it wouldn't that be nice? Hell, man, we could really hoodwink the market. Look at all these traders forgetting about Saturday and Sunday. Um, anyway, so there'd been a lot of back testing and a lot of research, and that really it doesn't mean squat. And so the way I look at it is I would rather do something on Monday morning than Friday afternoon because at least then I have some certainty. Now you could be lucky or something like that, but I don't like to rely on luck in trading because I'm just not that lucky. So anyway, that's what I have to say about that. And Ken, okay, I'm glad when you said hearing your definition of delta in your words make this very clear. I'm glad to hear that because I wasn't actually sure if I was explaining it correctly. But again, I try to find the simplest way on this stuff because my mind is kind of simple too. And also, I've been teaching a long time, and I know that if you what you don't, that's why I ask for emojis all the time. Because if people are getting like cross-eyed, then you've kind of lost them. So anyway, so I'm glad that worked. And yeah, that was helpful, Andy. That receiving premium that's so little, then one bad trade out of 10 can take it all away. Yeah, you could have one bad trade and it'll take a lot of premium away, but that's where your risk management comes in, right, Andy?
Mhm. Yeah, exactly. Yeah. I only mean to use the example as when you look at the probability, if that happens, that is the bad case, right? You need to handle that bad case there.
Yeah, yeah, exactly.
Yeah.
So, um, okay, guys. Well, listen, thanks a lot for coming. We've been going about an hour here. Andy,
Mhm.
I really appreciate you sharing what
Mhm.
you
No
know.
problem.
And hopefully, in fact, I know Sam's off for a couple of weeks, couple
Mhm.
more weeks doing taxes and stuff like that. So maybe we can do it again next week if you've got the time, Andy.
Absolutely. Yeah. We can talk about the way I did the Pfizer blue collar trade. It's a little bit different. And we can go over that and see what happened there.
I love it. Okay, let's do it.
Okay.
All right, everybody. Hey, thanks for coming, and we will see you next time.